Hello and welcome. The markets have had a difficult start to the year, with global equities mostly down across the world, while bond markets have also been volatile, with global government bonds registering negative returns. This has made it tough for multi-asset portfolios. While we were expecting volatility to pick up after a particularly quiet 2021, the current level of volatility and market movements are clearly higher than what we could have anticipated. We are approaching the end of a period of extremely accommodative monetary policy, which we have seen since March 2020, and this creates more uncertainty. With inflation remaining elevated, central banks are in a situation where they must act probably faster than they anticipated just a few weeks or even months ago. It's a difficult task to keep the global economy on a positive track while fighting accelerating price rises. All the uncertainty amplifies the current level of volatility. While it's of course easy to react negatively to recent market movements, the experience tells us it's worth taking pause for thought. Firstly, volatility and market losses were particularly low versus the historical norm in 2021, and so we anticipated more turbulence going forward. It's also worth remembering that overall equity markets have still performed positively on a one-year basis, despite the recent losses. We are currently at the start of the earnings season as well in the US, and this has been a key driver of positive equity markets since the rebound following the initial COVID-led drawdown of 2020. So far, if we look at it, US numbers have been encouraging, and despite some specific cases where companies have actually disappointed, it has been overall strong, with more than 75% of corporates beating analyst expectation for earnings and revenues. If we move on further on the macroeconomic front, COVID had an impact on consumption in December, as we've seen further lockdown measures that came into play. It has been a big month as well for data. While US industry surveys have, for example, disappointed, figures have been more robust in terms of global employment, the housing market, and economic activity. So in the short term, volatility is likely to remain elevated, and inflation data will continue to shape central banks' policy. With equity markets significantly lower than what they were at the end of 2021, this could prove to be an interesting entry point, and we will monitor it actively. We have higher level of cash than normal, which could be deployed if we think the time is right. Thanks for listening.